It's Wednesday at noon, and you know what that means. It's time for the Economic Warrior.
My money.
I get money from you.
Money in the bank.
Young money.
It's the rich man's world.
I'm as mad as hell, and I'm not going to take this anymore!
World-renowned financial advisor and best-selling author Barry James Dyke will arm you with the truth. This is the Economic Warrior.
Please note, the opinions expressed on this show are of the individuals who speak them, and not necessarily of Portsmouth Community Radio, its members, or Board of Trustees.
Well, good morning or good afternoon, should we say. And Phil, we're entering almost to the summer solstice. I guess tomorrow's going to be the longest day of the year, am I correct?
Yes, sir.
Yeah, well, yeah, so it's beautiful living here in New England, but we have a great guest today, a friend and a prior guest, Gretchen Morgenson from the Wall Street Journal. We're going to talk about stock buybacks and how that's going crazy. But you could just tell our audience a little bit about your background and how long you've been you were working for the Times, and then you've been recently moved over to the Journal, but what your line of work has been.
Well, unfortunately, I'm old, so we go way back. I did spend 3 years on Wall Street, and that's where I really got to know kind of where the bodies are buried and how things work in the real world down there. So that was early on, and then I actually was a writer at Forbes for many years, and then I joined the New York Times in 1998 and was a finance columnist and covered Wall Street and other arenas for almost 20 years. And in November, I jumped ship to the Wall Street Journal, where I'm now in the investigations unit with a great team of fantastic diggers. And so that's the story in a nutshell.
That's great. Now, I want to just kind of ask you just a general overall question, Gretchen, because you and I have been watching some of these bubbles now, and with everything that's going on right now, do you think we're in another economic bubble? I mean, when you look at the amount of the valuations on corporations, the margin debt's all-time high, equity exposure in people's 401ks and IRAs is all-time high. What's your take on what's going on right now?
Well, I'll tell you, I think that it is a distinct reaction and a very sensible reaction, honestly, to a low interest rate period, right? So people are desperate to have some sort of income. They can't keep it in the safe and sound, CDs and other, kind of fixed income investments that are secure, because you're just behind the eight ball constantly. And so people who are watching the stock market just climb inexorably higher and higher say to themselves, I'm a chump if I'm not in it. You got to be in it to win it. And so I think a lot of people have been driven into the stock market because of the low yields that you would get on more traditional safe money. So I think that we do have an issue with people who are probably in the market who ought not to be, or who are perhaps not prepared for a big downdraft. But I just think it's a human reaction to an issue where you can't make money any other way.
Yeah, it's I guess in economics, Gretchen, I guess it's technically called disintermediation, taking assets from safe places and forcing into more speculative, and so Wall Street can keep gambling with your money. And one of the biggest things I see, just kind of an indication, is the amount of stock buybacks. I mean, I'm floored at, and I guess it's an all-time high, and according to S&P Dow Jones indices, which is they said that the amount of stock buybacks were over $1 trillion over 1 year. What's a stock buy? First of all, please tell people what a stock buyback is.
Okay, well, companies are, there's a lot of reasons why companies are doing more of these, but how it works is a company goes into the market and its management decides that it wants to buy back shares. That means that they're going to reduce the number of shares outstanding. And so, this is allowed under SEC rules, and so they go in and they buy a set amount. They usually announce these plans, and they basically say, we're going to buy this amount of stock back, we think we're doing it. They usually have a different array of reasons, but typically they claim to be doing it because they think the stock is undervalued. And so it's been increasingly popular. And according to a resource that I use, and which I wrote about last week,
yeah.
the buybacks that we're seeing now, as of I think June, like middle of June or June 8th or something, it was $500 billion. So yeah, you could easily see $1 trillion this year.
Yeah, well, I guess, it was actually, I forget the guy's name, Howard Silverblatt or something like that, but there was $1 trillion between like April 1st, 2017 and March 31st, 2018.
I see. So that's the most recent year. Yeah, well, that would make sense.
Yeah, so it's like, now, so what's good about stock buybacks? I mean, I'm just asking you as a reporter.
Well, obviously what they do is they reduce the shares outstanding, which makes a company's earnings per share look better, right? Because the number of shares outstanding declines, and so therefore your EPS goes up. So companies like to do buybacks because they can make their earnings per share look better. There are a lot of other reasons, several other reasons why buybacks are popular among companies that are not necessarily shareholder friendly. And so one of them is that a lot of companies have, as a benchmark for executive pay, earnings per share growth.
Yep.
And so you can imagine a situation where a company decides to buy back its shares, its earnings per share go up, and the CEO gets a bigger bonus. So that is an issue that people do care about with buybacks and have found, some criticism because of that. So, and the other thing that I find very kind of dubious about buybacks, and you can't say this about every case, but it seems to indicate that you have a company management who has run out of ideas about how to invest in their business, right?
Yep.
So it's like you can't come up with anything better than a stock buyback, right, to run your company.
I know, I agree.
And so it's, you really have to wonder about that. The other thing that's pernicious about the buybacks is that when you have these paid at very high levels in the market, when a company goes in, after the stock has risen, you're really paying a rich premium to buy back the stock, and it might not be a good use of corporate capital.
Amen, Gretchen. And I'm going to throw you kind of a softball or a curve, whatever. I see some of these things like Eddie Lampert, and because actually we had Bill Cohen who wrote the article I never saw about in Vanity Fair about him running Sears. Eddie Lampert bought back shares as much as $132 a share, and I think Sears is trading about $11 today or something like that. And so it's obviously a poor use of cash. But then again, the company I like to pick on is that under General Electric, under Jeffrey Emmelt's tenure, he bought $24 billion worth of stock in 2016 and 17, and the shares went backwards. I mean,
right. So that was a perfect example of a bad use of corporate capital, and a perfect example probably of a manager, an executive who had nothing better to do, no good ideas about how to build the business. And we see it in GE's stock price. Look at it. I mean, the thing just got kicked out of the Dow Jones Industrial Average.
Yeah. Could you tell that? Because this is, GE. I mean, I remember as a kid, GE was the blue chip of blue chips. Okay, you buy GE stock and you can retire.
Right.
So GE, which was started by Thomas Edison, I guess, and J.P. Morgan, was I think the largest industrial company in the world, and but it get kicked out of the it's going to be kicked out of the Dow Jones Industrials next week. Could you tell people what that is?
Well, as you know, the Dow Jones is an index of 30 stocks that people believe sort of represents the overall market, i.e. they have an array of stocks, an array of industries in that index. And, the S&P is another index. They have 500 stocks, but they're supposed to sort of reflect the general, economy of this country by the big companies that are in it. So General Electric has been in the Dow for, I don't know, maybe 100 years or close to it. And so because the stock has just done nothing, it's been absolutely terrible performer. What often happens is those kinds of companies will be removed from an index because it's really dragging down the index, and investors obviously don't like that. So the decision to remove it from the index is clearly a reflection of the company's stock just being, dead money, if not worse.
But what replaced it with? I get a kick out. You know who replaced?
Walgreens.
Yeah, Walgreens, Alliance Boots, Walgreens. Okay, which was a how I love private equity, but that was a deal clobbered together by KKR and Stefano Pessina, or whatever it is, the Italian billionaire, which I was like, oh my goodness, there's more financial engineering. So GE got kicked out by a company essentially put together by private equity titans, which I found kind of amazing.
Well, that's the way the world works now. You know that. But another one, Apple announced that, I just see some of this as kind of a misallocation of capital. Apple announced this year $100 billion in buybacks. I mean, can't they come up with something else like a better Apple iTV or something like that? I mean, well, you would hope so, and that's been a pretty innovative company, and so I think that's the thing that people may be a little bit surprised by. But clearly with some of these other buyback announcements, it really, I think, is designed just to kind of propel the stock and make the stock look, like a better performer. And that's really financial engineering in my book, and it doesn't really add tremendous value. So there was an interesting thing that the new SEC commissioner did a study, and he's a former professor at Columbia and NYU law schools, and he commissioned a study on what insiders were doing after the buyback announcements were made, and what he found was that a lot of them were selling into the bounce. So when a buyback announcement comes out, then the stock usually rises because people understand that's good, that's bullish. And so what a lot of these insiders were doing was selling into the bounce. Now, that's not illegal, but it's sort of interesting, since many of these companies say, oh, we're buying back the stock because we think it's undervalued. Well, if you think it's undervalued, then why are you selling? So that was a really fascinating study to me.
Yeah, and then I look at it, this is just my opinion, the stupidity of it, like GE's case. I mean, they got I think their pension funding ratio, Gretchen, is something like 67%.
Really?
Yeah, it's like it's about as good as an airline, which isn't saying much. But they have like $30 billion in unfunded pension liabilities, and then I think they have another $7 billion in their SERP pension obligations. So I mean, to me, they spent $24 billion in buybacks, but they still have this huge obligation. And then it seems to be more about. I'm going to get into another debt question, but then. GE announced this year who's the new guy? Flannery? What's the guy?
Yeah.
He announced that they're borrowing money to fund the pension obligation. They're borrowing $6 billion to fund their pension obligation for this year. So it always seems to be about the debt. Am I correct?
Oh, for sure, absolutely. I mean, the problem with debt is that the value of the assets that you're, borrowing against can go down, but the debt, the amount you borrowed, stays the same. So you can have a situation where it's like a home equity loan or a mortgage. If the value of your asset that you borrow against goes down, then you're really in trouble. And a lot of people learned that lesson the hard way during the housing crash.
Yeah, so this is because and remember I'm old enough to remember in 1999, 2000 when Global Crossing in Adelphia, and who was the other big one?
WorldCom.
They all collapsed because of the debt. That was a major contributing
that's
factor.
right.
And so we
Right.
see that during the subprime crisis was all about debt and all these complex debt products, which no one can understand. But now, and there was a guy who works with the Journal, I think Matthew Wirtz.
Yes,
He did a great piece, which like kind of frightened me. He said that looks like AT&T is going to be taking over Time Warner, and Comcast is going to maybe taking over 20th Century Fox. But between the two companies, they're going to have $350 billion in debt.
Really?
That's what. Yeah, I got it from your paper, and and so bringing the total debt for non-financial companies worldwide to $11 trillion. I mean, haven't we seen this movie before?
Well, yeah, you're right to point out that the debt levels. What's troubling about that when that happens is, a stock market collapses or crashes or declines, they don't always devastate the economy, right? Like we saw in 2000 with the dot-com bubble bursting. There was a lot of stock market value lost, but it was not as devastating as the mortgage crisis. And it's just always that way, that the debt crises are far worse than equity problems. And so, yeah, you're right to point out the debt levels are very high, and, there's all kinds of lower quality debt being issued, junk and near junk, and, it's this low interest rate environment has really, really welcomed companies to the capital markets to raise debt, but usually there's going to be a hangover after a very good party.
Yeah, and then what kind of frightens me too, which we see the issuance of, was it covenant light debt. I know what it is,
Right.
but you could explain it to. They'll believe you, Gretchen. Maybe they won't believe me. But could you explain what covenant light debt is to our listeners?
Well, I think my understanding of it is that it really takes away from the soundness or the safety of the debt. So, when you borrow money, the people who are lending it to you usually want to have a pretty secure, recourse if something goes wrong. They want to be able to, get assets, be sure that they have the ability to get their money back. And so, in those kinds of situations, it's really a little bit more loosey-goosey, and people are accepting less security, as it were, for the debt, the money that they're lending to these companies. And that's fine when everything's going great, when profits are rising, but when it goes the other way, then you're kind of in a bind as a debt holder. You don't have the security that you thought you did.
Yeah, it's so that's what I've been researching, and I guess the covenant light issuance of covenant light debt has actually been higher, I guess, percentage wise in Europe than the U.S. But that's kind of so this is what we saw during the subprime crisis, and I wasn't really but these covenants have just been weakened. But so this is, don't you see? I just kind of see it. I mean, you don't have to be a weatherman to know which way the wind blows, but the student loan debt, it was at 1.4 trillion now, I think.
Right. Yep.
And then also we have the we have the subprime mortgages, not mortgages rather, but the auto loans.
Autos.
That's and who owns a lot of these subprime companies doing the subprime autos, Gretch?
Wells Fargo.
No. Actually, it's actually private equity. So actually, Blackstone.
Oh, I see.
Yeah, Blackstone's big in this space, and so we're seeing higher default rates on this. And although it's not the scale it was in the subprime mortgages, we're seeing that in subprime autos now. So I don't know what's going to happen.
Right.
But yeah. So that's the. So it's a. But another thing is we were discussing your industry. There was another piece. Who was the guy? The guy who writes about private equity in the Journal.
We have several people, so I'm not sure who you mean.
But there was someone about the someone who wrote about how the financial industry continues to extract rents out of people, and
Right.
so what there's happening. So although we're seeing a squeezing of the margins on the index funds and things like that, we're seeing the profit margins and other stuff on private equity, real estate, hedge funds, and so forth go through the roof. So, make a long story short, there's a guy by the name of Thomas Philippopon.
Yeah, tell us. Yeah, uh-huh.
Yeah. So he was saying that no matter what they do, Wall Street still gets their 1.5% to 2%. So
That's right.
And it's crazy, but it's just really so. Anyway, so well, we wish you best of luck on your new position, and
well, thank you so much. I appreciate it.
yeah. Matter of fact,
Stay on it.
Yeah. So what were you did something today? I can't remember what was the article you did today?
Oh, today, yes, we're a colleague and I, Tom Corrigan, are working on a series in the bankruptcy sector, and the reason that we think bankruptcy is a place to look right now is because of this debt, these heavy corporate debt loads that are out there. You know, the minute the profit machine starts to sputter, you're going to see some bankruptcies. And so what we're looking at are fault lines in the bankruptcy system in this country that really allow for potential abuse. And so we think the time is right to examine that because of these heavy debt loads that corporate America has been taking on. And so our story today is about McKinsey and Company, which is a
That's what amazed me.
advisor.
Yeah.
And, you know, in bankruptcy, you're supposed to be completely transparent, and you're supposed to reveal all your connections so that people can see whether there are conflicts. And they simply have not been doing that. And you're also supposed to be a completely disinterested party, obviously, if you're an advisor, because you are dealing with a lot of different people in bankruptcy who have a claim, and you have to determine whose claim is good and whose is not. And so you're not supposed to have a financial interest in the outcome of the bankruptcy. But McKinsey's private investment arm has had financial stakes in the bankruptcies, in the companies that they've been advising, which is a real no-no in that world. So that's the nature of our story today.
Well, yeah, I was kind of floored in that because what do they do? In other words, am I correct in saying maybe assuming they're buying the distressed debt of a company before it goes?
Yes, yeah.
Yeah. You know, this is so. That sounds like that's what private equity guys do all the time. You know, and then
Exactly. Well, you know, maybe they're just taking a page out of their book.
You know, and I couldn't believe it because you know I evidently they bought debt on. I was amazed. Edison, which was one of the biggest bankruptcies recently. Right. And then the airlines. Okay, I don't know how many times they've been bankrupt, but
they go in and out like a revolving door.
You know, so I was like, can they do this? I mean, I was really kind of amazed. There's something you see in private equity, but I never thought McKinsey. I mean, they're supposed to be independent.
Well, good. I'm glad it raised an eyebrow.
Yeah, well, I thought of it anyhow, but they want to make this stuff so complex. But
yes, exactly.
You know, and keep pushing back the frontiers of ignorance, Gretchen. Because
okay,
you know, because
thanks for having me on. I appreciate it.
Take care and God bless. And we'll stay connected. Take care and God bless.
Alrighty.
Bye-bye.
Bye-bye.
This has been The Economic Warrior with your host, Barry James Dyke. Broadcast live at WSCA Portsmouth Community Radio. Engineered by Phil Kleiger. If you have any questions about today's show or need an ally in conquering the battleground of finance, contact the warrior himself at barrymjamesdyke.com.
Who are the warriors?